Hey, hi. So I'll take you through what's been up with gold and silver and what our thoughts are and what the expectations should be going forward. So we've been investing in gold and silver since the inception of the strategy, and those were not small weights; those were pretty large weights of 10% each. And precious metals did become a core of our entire portfolio. Right? And going forward, we do see that the opportunity might be a little lesser since the volatility has been higher. So if you see from this particular chart, it's been a one way up, right? And the most important thing on the right is that margin trading for spot has been continuously going up. And if you see over the last 1 week or so, even Shanghai exchanges have increased their margin, and MCX also has increased their margin on gold and silver. So that clearly tells you that there is a lot of speculative activity that's happening, and investors definitely need to be cautious going forward in relation to gold and silver. Now, if you look at how did certain triggers come in for commodities to take stage in 2025. Now, we are in an era where dollar is expected to remain cheap, meaning it's expected to remain competitive. Not that the currency would go down, but it would remain competitive. The relevance again is in question, but the whole fact of currency being uh, devalued across the world is becoming a very strong trend. This is one of the most important aspects of looking towards commodities in general, not alone gold and silver, but copper, lithium, everything else start coming into this picture, given that there is a weak dollar scenario going forward. Supply issues have been there. So if you look at what gold miners have been doing, production levels have been going down, and the ounces that are coming out of these mines also are going down. Right. Usually, what happens is when the price of gold or silver starts to go up, you get older inventory. You can dump all the low grade inventory in the market. But this time around, that trend has not been very strong. Right? So there have been a good amount of supply disruptions, and central banks have been major buyers of gold and silver, given the geopolitical tensions that are there. Now, this demand plus supply scenario has created a extremely strong run for gold and silver. That doesn't mean that this run cannot happen going forward. It definitely can, but the whole idea of it being being very speculative right now is one of those reasons for us to be completely cautious, both as managers and for you as investors, right? So this stellar run up, and if you read recent articles, Goldman Sachs saying $6,000 sort of targets, that clearly says that there is so much of optimism that is coming in into such safe havens and deemed to be safe havens, that you have to take a contrarian stance towards it and move towards undervalued parts of uh, the market. So debt is an undervalued part of the market. Within equity, there are certain parts of the market that are extremely cheap. So moving there makes a lot more sense than sticking on neck out for precious metals right now. Right. Have we seen this volatility before in gold and silver? Yes, we have seen this volatility in gold and silver. They are definitely prone to 30-40% sort of drawdowns because their supply is less, plus the contracts that get traded also are very niche. So basically, we're dealing with whales in the market. So naturally, you have to be extremely cautious when it comes to gold. Hence, we have slowly been cutting off our position on gold and silver. Right? That is a very evident trend. If you go through how our portfolios have looked over the last couple of months, that trend is here to stay. If you look at drawdowns versus that of Nifty, Nifty does have drawdowns of 30 odd percent, but precious metals going by history in 2008, 9, 10, and 11, we did see a stellar run up then, and again a 30-40% drop from there as well. Right. So this scenario and that scenario is no different. There are bigger players in the market, so you definitely have to be very, very cautious when it comes to precious metals going forward. Now, what has happened to our ETFs in India? Our ETFs over the last 1 year have doubled, more or less doubled, right? With the premium and the inflow currently that is going into ETFs markets, our ETFs, though certain ETFs are pegged towards MCX, but broadly have seen that volatility up as well. And on days we have fallen more as well, right? So new silver ETFs have attracted very, very hot money that is contributing to this sort of volatility compared to gold markets. Silver has been a lot more volatile. We expect that this volatility will remain. Right, so you have to be very, very cautious when it comes to gold and silver, particularly ones that are not pegged to MCX. Now, uh, this is an interesting chart that when the US crashes, gold is crashing faster. See, you have to look at gold and silver as alternate currencies, right? So it's not sometimes that the hedge works, it has been working all this while. But if you remember, even during there was a phase even during COVID that equity also was going down, precious metals also was going down, everything was starts to go haywire. So we did get multiple queries and questions on, if equity is going to go down, then gold is going to go up. If debt is going to go haywire, then there will be one asset class that goes. It's not necessary that it works this way, but there are phases in which if there is a broad-based sell-off, money that is being pulled out of the market, we do see that level of volatility happen across all asset classes. So it's not necessary that one should go up and one should go down, but over a long period of time, they do act as hedges. So understand that when you look to do such decisions and when you look to make such decisions, go with the expectation that this should be 8 9 years worth of, as the cycle starts playing out, as risk starts to evolve, right? This would protect me over a long period of time, right? From a shorter time period, you should not look at, suppose there is a broad base, you cannot expect that it would work the way it is written in books and theories. But over a long period of time, it does tend to move in that particular angle. So do take note of that, right? Now, foreign central banks hold more gold than US treasuries. So, US treasuries, your large developed and developing central banks have been selling. So, China has been selling. Europe is on the verge. They have been reducing. Japan still stands to be the largest holder of US treasuries. I think yesterday the news came that India does not see that they would be reducing their holdings of US treasury. But broadly, central banks have been increasing more and more of gold on their balance sheets. Now, can this trend remain? Yes, this trend can definitely remain. As long as there are geopolitical tensions, as long as currencies are weaponized, there are trade wars, tariff wars that are there, central banks would want to de-risk their own portfolio to move towards alternate parts of the currency market. Right. So this trend can definitely look to continue going forward as well. We cannot predict the pace at which it will go, but definitely it would tend to go over a long period of time. Now, when it comes to household wealth, China and India still stand to be on top, where we have more gold in the locker than most central banks do on their balance sheets. But this is again a trend that will look to continue. Now, I would definitely leave it up to you. You can put it in the comment box as well as to what you are doing to your physical gold and your physical silver, because these are all stats and this might not matter. When we are talking one on one with each other, so you will have a better idea what the trends are when it comes to holding physical gold and holding physical silver. So put your comments in the chat box. But going from a data perspective, again, we are all gold consuming nations. We will continue to put money in physical gold. It is generational wealth that gets passed on for us. It's more sentimental than for the world. So naturally, we will look to do it. Now you have to tell me at what price do you say, hey, this is too much. I can't really go and put money into physical. So that I leave it up to you. Please do put it in the now. Over the last couple of years, we have seen very strong demand. But what's happening in the shorter term side? ETFs are now taking more and more. So as money is going into ETFs, we are seeing a lot of contribution in gold physical purchases coming from ETFs, right? So central banks are definitely purchasing, but the pace of the ETFs that are coming in are far more higher than that of central banks. That usually happens when momentum starts coming in. So we did see during 2020 and 2021 when the momentum came in for gold from $1,200 all the way up until $2,000, where ETF demand led to an increase in the price of gold. But this time around, we have seen strong demand from central banks that has led to a price increase, as well as ETF demand. So retail money also going in, that has led to an increase in the price of gold. Supply issues, supply issues are completely different. That is going to remain for commodities over a long period of time. That is not a new trend that's there. That has been a trend over the last 20 years as well, and will continue to be the trend going forward as well. Right? But demand at a particular point starts to go off as and when price starts to become a little bit more expensive. And that is the nature. More supply starts coming into, or more of these ores start coming in, more of these mines start putting out gold into the market, silver into the market, and that does lead to some sort of a balance in terms of prices. Right. So that narrative of supply demand is there and it's held for the long term. But for the short term, you definitely have to take price calls to understand whether it is the right time to take a increase in position or a decrease in position. Right, but recent trends do suggest that retail money has been flowing into ETFs, and hence that has propped up the price of gold and silver as well. Now, this was an interesting chart that came in from ICICI that the fundamentals are already priced in. Right. So silver, we get the narrative always that silver is being used in industrials. It is an industrial metal. So why wouldn't we expect that this would be a recurring trend year on year? Right. Look at this. High prices may force manufacturers to pursue something else. Thrifting is just one thing, but something else, right? Some other alternate metal with more or less the same compound, with more or less the same uh, uh, so you do see that manufacturers are looking towards alternatives if the prices go too high, right? So this narrative is always in question, right? So most of the fundamentals are already priced in at these levels, and actually it is far more than that premium that's there in the market, right? That warrants for you to be extremely, extremely cautious because precious metals is not very, very good. It is they are extremely illiquid in nature. So when there is no activity that is taking place on precious metals, it's a very good time for it to continuously keep buying, uh, action towards precious metals. Right now, this was a very very interesting thing that happened last. I think it was last Friday or so. Uh, but within a couple of hours is where silver crashed. Like I said, there are whales in the hence you cannot predict the nature. We did predict that silver prices are going parabolic, and hence are but expecting 30% in a matter of a couple of days, in a matter of hours, that is not something that we can do. But we can need to take risk, and this was a very very risk that played off. This was known to the market as well. There have been many articles and many videos that have been coming in, and we have also talked about how have to take a back step when you see something extremely parabolic happen in certain parts of the market. That part you have to definitely take a call. Now, what is the current scenario looking like? Current scenario seems that these metals are slightly normalizing and they can become attractive. But does that warrant more money going in? That is a call to take sometime later. But going by just number, we do see that at peak levels, it has come off its peak, and it is interesting to again view to see and have a very hawkeye sort of view to understand whether this is a good place to be putting on into or not, right? But the whole gold to silver ratio, and there were periods where silver was high, and then there were periods where gold was a lot more attractive. Both the metals are having that period where they are normalizing to fair levels, and if it does go below its fair value, then it does warrant for us to relook and take a call later on. But it cannot be today, it cannot be tomorrow. You'll have to take a as and when things start. Now, how did we catch this itself? How did we invest in Neo and maintain that level of conviction in these two particular? Neo maintains a no cap on any asset class sort of a framework. It is a mix of top down and bottom up on all asset classes. Plus, it is concentrated across themes with the Now, our idea for investing in precious metals since the inception of the strategy has always been we need to have an alternate currency in the portfolio that protect against geopolitical tensions and inflation risks and whatever wars or anything that can come up. Back in 2018, when things were extremely cheap for the precious metal part, where gold was about $1,200 or so, we were actually looking to invest. Now, this in the strategy came up in 22, but we have been buying all the way up until 2018 on our milestones to wealth sort of platform, right? So there is no cap. We can go from 0 to 100 also. So we have seen 20 odd percent sort of exposures coming into precious metals, yeah, in our history of inception, right? Now, where does this come in our India? Comes in the down opportunity, right? So we were seeing that dollar is getting a lot more weaponized, and large countries that energy rate would want to move away from the dollar, and that given the fact that dollar at that point remained very expensive and inflation levels were very high, it would make the dollar to become a lot more competitive towards other currencies if they have to maintain a good level of growth. That is playing out today after nearly 4 years. Right, and hence you see gold and silver at where they were. But this narrative has been there with us in 21 and 22 when we realized that the dollar cannot remain very expensive going forward. Right, so they have to weaken for them to remain competitive. Hence, that call to take commodities and particularly take gold and silver. Is there an option for us to take other metals? Yes, there is an option to take other metals as well. There are ETFs that we can take on NEO, which are investing in broader parts of the metal at the domestic sector. Right. So this part comes in the top-down opportunity level, and they do come into an active-oriented strategy. So despite it being an ETF, we actively manage the weight to make sure that we are one well positioned to gain, and second well positioned to use it as an optionality to gain from other asset classes when we are able to shift from an overvalued asset class to an undervalued asset class. Right. So seamless transition is what we are looking to do. Some examples of us doing this on equity is that we were able to do it in public sector banks. From a passive perspective, it was a top-down category. It was again on the passive side, and we were able to buy the basket. So hence, it takes us some amount of time to continue to buy that particular idea and subsequently sell that particular idea. So it's staggered in and a staggered out with no cap on a particular category. Right. Our entire idea was to build versatile portfolios across markets. So if you ask us when is a good time to invest in NEO, any time is a good time for investors to invest in NEO. And NEO particularly is for non-resident Indians. If you are in India, then see that particular product for you where we can take mutual funds as well. But particularly for NEO, it will be more on the ETF. In terms of performance, this is slightly dated, but the idea is that we have been consistently performing, and you would have heard that Sphere and NEO both have come in the top 10 performing strategies of India in 2025. But our expectation for this particular strategy has always been inflation plus minus 2%. Right? How do we handle drawdowns? We have seen almost 10% or sort of drawdown since inception. It is more than the multi-asset, so the beta is slightly higher than the multi-asset index. But from a Nifty perspective, we are definitely better placed when it comes to multi-asset sort of frameworks compared to multi-asset mutual funds as well. Definitely, this strategy is better placed than them as well. I'll see you all next time. Thank you so much.